morning, good afternoon, and in some cases, good evening. Thank you for joining our Absolute Impact 2024 webinar today, where we will discuss 30 or so oil and gas companies' climate goals. You can download the report via the QR code shown on the screen. I am Simon Perham, part of the investor engagement and outreach team here at the Tracker Group. The intended runtime of this webinar is 50 minutes, dependent on the number of questions asked, but there is a 60-minute hard stop. A short presentation of the key points will be followed by a panel answering your questions. And if you would like to ask a question, please do so via the Q&A function. Please do not send your questions anonymously, as if we are unable to answer it live, we will attempt to follow up afterwards. The slide deck and a recording of this webinar will be sent to you afterwards. Carbon Tracker is a not-for-profit financial think tank. Our vision is a fully decarbonised global economy well before 2050. All of our research converts climate science into financial risk and reward, with the aim to accelerate the energy transition by mobilising the financial markets. Our work, including this report, is free to access / download from our website, as well as the regular third-party investor platforms. Presenting today is Olivia Bisel, an associate analyst in the oil, gas and mining team and lead author of Absolute Impact 2024. Joining Olivia to run through the new methane methodology is Rich Collett-White, an analyst in the same team. For the panel and to answer your questions, we are delighted to be joined by Mr. Luis Cabra, Executive Managing Director of Energy Transition, Technology, Institutional Affairs, and the Deputy CEO of Repsol. Luis is a member of the Repsol Executive Committee and leads on, amongst other things, the development and implementation of the company's energy transition strategy. Joining Mr. Cabra is Mr. Antonio Lorenzo, Repsol's Chief Financial Officer. Antonio is also a member of Repsol's Executive Committee, and aside from being the CFO, his responsibilities also encompass the relationships with analysts and investors. And lastly, Mike Coffin, Head of Oil, Gas and Mining at Carbon Tracker. The session will be moderated by me. I am the voice of the audience, your voice. So please type in those questions. Olivia, over to you.
Thanks so much, Simon. I think we can move on to the next slide, please. Thank you. So just to set the stage for why we're interested in emissions targets, why we wrote this report and keep writing it each year, we're really concerned with emissions targets through a two-pronged lens. So first, of course, we're interested in knowing the climate impact of corporate activities. So this is a key element that we see for Paris alignment assessments, which is relevant for not only a company's social license to operate, but it's really relevant for investors and other financial institutions that have set net zero goals. But beyond that, and if you could click through, please, Piotr, we really see emissions targets as relevant for transition risk. So when we view emissions targets as a proxy for future production plans, for example, they can provide a really good signal of a company's long-term exposure to energy transition risks, such as substitution of demand for oil and gas. And this translates to financial risk for investors in the form of lower returns. And thinking about methane in particular, we want to understand how corporate action on methane, mitigates a company's exposure to methane-related regulations as well. So that's one example. So what does our report do? Our report assesses the emissions targets of 30 of the world's largest oil and gas companies. And we look at four main points. The first is are companies' emissions targets appropriately framed so that they, map onto the Paris Agreement and they mitigate a company's energy transition risk? What are the trends over time? So thinking about how a company has been, improving in its emissions targets over the past several years or regressing, and then also how it stacks up against other peers, be it in its own jurisdiction or worldwide. And then fourth, beyond are the emissions targets framed appropriately? Are the strategies that a company is setting to achieve those targets credible? So, for example, not overly relying on CCUS, not overly relying on nature-based solutions. Moving through to the next slide, please. So I mentioned we've written this report several times before. This is our 5th iteration, and this really allows us to assess a company's trends over time, and also, pick up on how companies are responding to the evolving energy transition and how stakeholders are impacting targets. Could you please click Piotr? A couple new points for this year. The first is we've introduced methane specific targets into our assessment framework, which is quite important, as my colleague Rich Collett-White will get to in a moment. And then second, if you click through, we assess 5 wholly state-owned NOCs, national oil companies, for the first time. And this is important, in light of growing stakeholder investor demand to assess more of these types of companies, especially because they are big and typically high emitters. So my colleague Rich Collett-White is leading our workstream on methane research, and he'll touch base on why we're introducing methane into our framework.
Thanks, Liv. So just to give a bit of context on why we've decided to include analysis on methane targets this year, it's now widely recognized that significant near-term methane reductions are needed to keep the Paris Agreement goals within reach. And that's because of the potency of methane as a greenhouse gas. It's 85 times the warming impact as CO2 over the first 20 years after it's released. Around 30% of temperature rise is caused by methane emissions, and it's much more likely that we're going to overshoot Paris goals without greater action on methane. It's also worth saying that there's a huge amount of momentum around this at the moment. It's been building rapidly, most notably through the Global Methane Pledge, but there's a whole host of other initiatives. And that's really leading to much greater expectations from policymakers, from climate conscious investors, from civil society. And that's particularly on the oil and gas sector, because the kind of methane reduction measures that are available to the sector are cost effective mostly, and technologically viable. And it's also because there's a kind of increasing detection and monitoring capabilities around methane. And you can see the methane plume image on the right there. That's from a NASA satellite, just as an example of that. And then in terms of corporate commitments, these are growing as well through initiatives like the Oil and Gas Climate Initiative and the Oil and Gas Decarbonisation Charter. And so we felt that it was important to do some analysis on methane specific targets specifically, because that allows us to kind of assess ambition on this as distinct and kind of disaggregated from CO2 targets. So hopefully that's been a useful overview, and back to you, Liv.
Thanks, Rich. And next slide, please. So just digging into our methodology a bit more, fleshing out, what an appropriate framing of emissions targets looks like. We look at 4 main hallmarks. So we would like to see emissions targets that cover full life cycle emissions, given that Scope 3 accounts for the vast majority of oil and gas life cycle emissions. We would like to see across Scopes 1, 2, and 3 a target for net zero by 2050, as well as absolute interim reductions to make sure that companies are tracking. And then we also want to make sure that these targets cover the full gamut of business activities, so both operated and non-operated assets. It should also cover downstream product sales from third-party crude. And so those are for the overall greenhouse gas targets. And then for the methane-specific targets, we would want to see a goal for near zero methane by 2030, for both operated and non-operated assets, and these should be covering midstream gas assets where those are applicable for companies. Next slide, please. So what did we find in our assessment? Caveat, this picture on the screen is just an excerpt of our table. For the full kind of evaluation of our 30 companies, please go to our report. But this illustrates the overarching point, which is that no companies we find to have Paris-aligned emissions targets, i.e. targets do not sufficiently link through to global greenhouse gas budgets on a finite basis. And this is similar to last year in terms of the results for the overarching greenhouse gas targets, and then for the methane specific targets, Rich will get a bit more into those results. But kind of long story short, there is still work to be done. Next slide, please. So in terms of how companies are stacking up against each other, which is, of course, very relevant for investors. For an overall greenhouse gas target perspective, we do see fairly similar ranking of companies as last year. And this is primarily because there haven't been very notable changes of targets, despite some new announcements among a few of the big companies. We don't see this materially affecting how a company's emissions targets are linking through to global greenhouse gas emissions on a finite basis. Among the companies that are new to this year's company universe, particularly the NOx, they rank fairly on the low side. So they're all in a red tier, which indicates that they don't have a scope 3 target. And then Rich will cover the methane specific results for our analysis.
Thanks, Liv. Yeah, so as you can see on the right there, the hallmark for our methane specific targets, that's composed of 3 components. Firstly, you've got whether a company has set a near zero methane target by 2030, and that can be on an absolute or intensity basis. Then you've got whether that target is on a full equity share basis or just operated, and then finally whether that extends to midstream gas assets as well. And so what we found here is that yes, the majority of the largest kind of oil and gas producers in our universe, they've coalesced around near zero methane by 2030. You can see lots of yeses there, and that's in line with the kind of expert recommendations on this. But only one company, Chevron, has an equity-based target, so that includes its non-operated assets. And so that means that almost all companies are overlooking quite a significant amount of their production, and that's particularly the case of European and US IOCs, which produce a significant amount of oil and gas through joint ventures, and that's happening in countries with often quite high methane emissions, such as Algeria and Nigeria. And then also you can see there that many companies have not set targets covering their midstream gas assets. So that's their pipelines and LNG facilities. And that's despite the fact that this segment does contribute significant methane emissions. And then you can also see that there's a kind of a lack of standardization around some of these targets when you look into them. Near zero is defined differently by different companies. So some will have much more ambitious kind of goals than others. And there's also kind of issues around the way some of the intensity targets are designed. I won't go into that here, but please do look in more detail at the report. Next slide, please. And so, yeah, I think it's important to say that targets, they're only really as good as the actions being taken. So we've used 2 indicators here to assess credibility on methane reduction. Firstly, looking at the OGMP program. Many of you will be aware, but independent studies consistently show that there is significant underreporting of methane emissions by the oil and gas industry. And that's because they often rely on kind of generic emission factors rather than direct measurement. And the OGMP UN-led program has been trying to fix this. And so we've looked at which companies are assessed to be on their gold standard pathway. And you can see that while lots of them are on that pathway, that doesn't indicate that a company is directly measuring all of its methane emissions from all of its assets yet. So that's a kind of significant limitation there. And also you can see that on the right there, with zero routine flaring by 2030, most companies are now aiming for that, which is positive when it comes to Paris alignment. But there are also limitations there because this is only focusing on routine flaring, and there's lots of other flaring that goes on. And also venting is, when you look at the data, a much bigger contributor to methane emissions than flaring. But there's lots more detail on this in the report, so I won't go any further there. Back to you, Liv.
Thanks, Rich. Next slide, please. So just to get kind of a big picture overview of the so what here, we don't just want to think about emissions targets when we're looking at climate impact of a company and transition risk as well. So we kind of wanted to give a big picture idea of what other metrics investors should be cognizant of and assessing when they're looking at corporates. So beyond emissions targets, factors such as, investment and production plans, executive remuneration, lobbying, and commodity price forecasts are all relevant, both for climate impact of a company, but both transition risk. And I won't go through, the nitty gritty of each of these line by line, but our report includes more detail on this for those interested. Next slide, please. So just to wrap things up with some of our main takeaways from our analysis, as Rich has discussed, methane is a significant blind spot that's increasingly relevant for investors. We do find that NOx are lagging, particularly compared to European peers. We find some issues with the credibility of strategies for achieving targets. And then we also view, these targets as relevant, not just for Paris alignment, but also for transition risk. And we really recommend using this analysis as a tool within the investment screening process to support, corporate engagement. So those are our main takeaways. You can see the QR codes up on the screen to download both the absolute impact report, but also the company profiles, which go into specific companies in our company universe, not only from the emissions target perspective, but also other metrics. And Simon, I'll hand the mic back to you. Thanks.
Great, thanks, Olivia. Thank you, Rich, for that. Just a reminder, we've got some questions already coming in. Please, if you could put your questions in the Q&A function in a timely manner. We've got quite a lot to get through, and we would like to make sure that we get as many questions answered. Before we go into the nitty-gritty, I just want to bring back a question that Thomas has on the oil and gas methane partnership and its gold standard ratings. We can see that Carbon Tracker is using it, but if you wanted to go to a platinum standard rating, what would you go further to include? Rich, Mike, if you're there, Olivia, over to one of you.
Sure, happy to jump in here. So yeah, I would say that the OGMP program really is the best in class, but it's just that there's still quite a long way to go before companies are at what's known as the kind of level 5 reporting on OGMP, and that means that they're directly measuring all of their assets, both their operated and non-operated. So yeah, still some room for improvement. There have been it's worth saying that there have been some updates since we published this from OGMP, and now some companies are deemed to be at gold standard reporting, but that still doesn't mean that they're all at level 5, and that's the kind of crucial thing for direct measurement, in kind of independently verified. And until that point, targets really should be viewed with some skepticism, and disclosures around methane should be viewed with some skepticism in our view.
Before you go, Rich, a question in from Josh. As we learn more about the large share of methane emissions from the midstream sector, and you did mention that briefly, what are your plans later on to incorporate those type of emissions into future reports?
Yeah, so so we've got one of the components as midstream gas, and it's worth just clarifying that the reason why it's midstream gas and not midstream oil is because you don't really get methane in the midstream oil segment. So the focus is really on midstream gas. We could also kind of extend that to downstream assets, but again, methane isn't a huge issue there in general. It's mostly an upstream kind of issue. But I don't know if Mike, you wanted to come in on that.
No, I think, well, I mean, Richie, I think you covered the main issues there. I think we're obviously looking to continue to evolve our analysis to make sure it's relevant and reflecting best practice assessments of the industry, both to assess individual company performance and continue to drive the industry to improve its performance and ultimately demethanize oil and gas production over time. And obviously bring the industry along too by identifying leaders and laggards. So yes, we'd continue to evolve the analysis as we have done over the last 5 years where appropriate.
Okay, Piotr, would you mind taking the slides down from the screen, and then we can bring the panel in, and it's great to be able to bring our guests from Repsol in, and this is really a question for Mr. Cabra and Mr. For Antonio. Repsol, we'd be interested in hearing an accepted wisdom by the investment community seems to be that pivoting away from oil and gas destroys shareholder value. Yet you seem to be doing quite a lot of that. What is your experience?
Okay, so thank you, Mike. I believe that this question about creating or destroying values is more a question for individual companies rather than sectors. I believe that it's too generic to say that you can create or destroy value whether or not you pivot from oil and gas and this be of application to any company. So looking at individual companies, I believe there are two key elements in order to check whether or not you can create value or destroy value on that. One is your own view on the energy transition speed and pace. And you need to take a view. If you are in this sector, in energy company, you need to decide whether or not the energy transition is running at a certain speed and then apply your strategy accordingly. On the other side, I believe that the other element is how you can build a certain pace of energy transition building on your own competitive advantages. This is too generic, but if I can go a little bit on the details of what we did, we decided that driven by technology and also by regulation, especially in the European Union, the energy transition is going on. It's already happening. So our business needs to adapt to that and move and even be a little bit ahead of that. And second, speaking about our competitive advantages, so we went business by business and said, okay, for E&P, it needs to be a cash engine in our portfolio. We have sufficient reserves and resources that we can exploit along the decade. We do not have to spend a lot of money on frontier exploration. We are going to keep our production relatively flattish, coming from a maximum of 700,000 barrels a day. Now we are in 550. That's okay for us. We want better barrels in terms of dollars and in terms of CO2 footprint, lowering the CO2 footprint. Then we decided that if we want to go to move sufficiently fast into net zero, and because electricity is the growth vector in the energy transition, we were going to enter the renewable electricity generation. We have already built a big pipeline of projects. We are going to have 6 gigawatts by the end of next year. And we started in Spain because the market we know better, or we know best, and also wood wind and sun resources. In our industrial sites, we have very competitive refineries, first quartile in margins in the European Union. We will transform and not close these refineries, reducing the inputs progressively of oil and moving to renewable liquid fuels and liquids and renewable gases. And finally, for the customer, we are going to provide to them progressively increased volume of, let's say, renewable molecules and renewable electrons. So all this together, I believe, is a result of our view of the energy transition is going on, and also building on our own competitive advantage. Then, project by project, you need to have a sufficient returns on your investments, and that we are checking project by project.
Yeah, thank you, Mr. Cabra. Question for Mike, I think. We've got a question here. What is the best practice when working with Algeria, Nigeria, etc., for methane when in a joint venture with an national oil company? What does Chevron do versus others? Do they have more influence, or is this due to their partners that agree to this? Maybe
so I might, yeah, happy to talk about that, and I might pass to Rich in a moment for the specifics about Chevron. I think taking the general question, our view is, I think it's sort of a multiple perspectives of this on this at a really high level. If companies are setting targets in a way to position themselves as compatible with Paris goals or part of the solution on climate and ultimately reducing the impact of their business activities, if the methane targets are not including emissions from third-party operated assets, ultimately the business activities from which they presumably profit, are sort of outside scope. So we think that is a bit of a disconnect. But it's a disconnect from that sort of credibility perspective around credibility of targets and the way that they're being achieved. But ultimately, it also sets companies up for a increased exposure to regulatory related risks. So, for example, as the rise of satellite technology continues and you have more granular data and monitoring of methane emissions from assets around the world, ultimately, there's going to be a better ability for a range of stakeholders to identify leaders and laggards and some of the worst performing assets. And combined with increased regulation, so for example, EU methane regulations about, for example, cargoes being imported into Europe, we expect to see a point where there are some cargoes of products and other cargoes where the emissions footprint is just too high associated with them. Those cargoes will be banned ultimately from entering, or at least will attract a very high tariff relating to them. So we think it's very good. It ultimately comes down to important for good business practice to work with partner companies to reduce methane emissions, both from a investor engagement perspective and a corporate positioning perspective, but fundamentally from a business risk perspective and exposure to regulatory related transition risk. And I think while many of the companies are currently disclosing their emissions on a full equity share basis, that's one thing about historic performance, but for us, it's about setting a forward-looking target, which ultimately is indicating to the market corporate strategy. And that's where we think there is that big gap around the lack of third-party emissions, apart from for Chevron. Rich, perhaps I'll pass to you about if there's anything you want to add specifically on Chevron and kind of why we see that why they've set that target in our view, and perhaps how they were able to.
Sure. Yeah. I mean, so from the analysis we did, we didn't find huge evidence of Chevron kind of making big efforts with its joint venture partners on methane, at least not compared to some of the other companies that we looked at. So Total Energy, Equinor, some of the other European majors are making some concerted efforts to try and address those non-operated emissions. So with Chevron, I suspect it could be because it has kind of less non-operated production going on in high methane emitting countries, but yeah, it's very difficult to say. So yeah, it would be often it comes down to a kind of lack of disclosure or lack of sufficient disclosure from companies on this.
Okay, so we'll recognise that the methane disclosure system or process is pretty early in its sort of journey, for the want of a better word. I just wonder whether we can bring Repsol and Mr. Cabra again to ask him. I mean, Repsol has been ahead of the field in largely in emission disclosures. How do you think the industry will tackle this tricky full equity share gap? What and therefore what should investors be expecting from either yourself or the industry going forward to close this difficult conundrum? Should we expect greater clarity in methane in contracts that are set up with the joint ventures, for example?
Mm-hmm. Yeah, I believe that definitely, and the OGMP initiative is an example of that, putting some sort of gold standards that go progressively towards dealing with incremental perimeter, I would say, of your emissions. This is the right thing to do. On the other side, we need to be sufficiently pragmatic to see what is possible and what is not in this stance. Definitely, it's very crystal clear that when you are an operator, you have a lot of levers in order to reduce emissions, and that's no need to say everyone which is operating has in its hands the capability of reducing methane to near zero by 2030. When you are in a joint venture, it all depends on which are your partners. And definitely, if we are now building a new contract, we will be much more pushy on incorporating, let's say, the obligations of the operator to be a responsible operator. This is already in the JOAs, but in the future, responsible operator will mean also tackling emissions and committing to reduction of emissions to certain standards. And again, I say that OGMP is the right way to go with methane. But definitely, and we are now in certain situations in which contracts are already in place, number one. And second, the operating partner, sometimes national oil companies, these other type of companies, they have not the same regulations on one side, and they do not have the same, let's say, pressure to react and reduce emissions. If the contract is in place, the single thing we can do, and we can do many things, is first experience sharing. We've been building workshops, etc., to show techniques to the operators about what they can do if they wish. And second, going to the governance that we have in place, and we can put on in terms of the executive committees, the operational committees, ideas about we need to invest on this and that. We can do that. And very important, and I believe this is getting very, very good, engaging these national oil companies and other less advanced operators in global initiatives. If they engage with OGMP, they take certain commitments to proceed and to go ahead with that. If they engage with oil and gas decarbonization charter that was launched in COP28 last year, it's going to be the same. Even encouraging national oil companies to engage in rankings like Carbon Tracker. All this is very important because in a moment and during years in which it's going to be voluntary up to the operator to engage, all these are the levers that we have. But definitely for the future, it's going to be regulation, spreading around, and also for us being more pushy in the new contracts.
Thank you. While Mr. Cabra catches his breath, Mike, maybe I can turn to you and ask, what do you think's been the greatest effect of setting climate goals, corporate setting climate goals?
I think there's. Perhaps if I go first, I think that there's a few different aspects to this. I think clearly one would be around differentiation of peers, and I think Mr. Cabra was just talking about this in terms of perhaps some of the differentiation, and I think this is why we included those 5 fully state-owned national oil companies this year, is actually really is to identify leaders and laggards. And I would agree with the point about, there is an element here of working collaboratively to bring the NOCs forward. Clearly, there's a long way to go. So differentiation versus peers. For now, I think you've seen some of the Europeans in some ways appease the climate concerned investor base. But actually, for how long is that really going to last? Particularly as you dive under the hood, not least with things like increased disclosure requirements and increased ability to assess corporates and their performance. I think it is allowed those companies that are delivering delivering better than peers to get an advantage. And I think that's particularly the case with methane. I mean, I always sort of say that you can't really decarbonize oil and gas production. Given 85% of the emissions result from end use, you can tweak at the margins the operational emissions, but are ultimately setting scope 3 emissions, and decarboning oil and gas is planning for a production decline. But you can certainly demethanize oil production, existing production. And so if you are setting those targets, then you are differentiating versus peers. And I think the key point is the corporates that have started on that journey and are better positioned around methane performance, as those additional ability to detect leaders and laggards and additional regulation comes in, those companies are potentially ahead of the curve versus their peers. I think on the flip side, an unintended consequence of setting climate goals has been around the backlash from the US investor base. And I think I think when we talk about climate goals, there are two things. There's one, which is reducing the climate impact of your emissions, and the other part is reducing your financial risk exposure to climate-related transition risks. So on the latter part, corporates that are moving away, and perhaps we'll explore this, we can see some of the other questions coming through in a bit more detail, but pivoting a strategy on climate, i.e. planning to move away from oil and gas, at least in the long term, would better protect shareholder value compared to companies that are continuing in a business as usual.
Mr. Cabra, anything to add from a corporate point of view? What has been the greatest effect to Repsol of setting climate goals?
Well, saying that, answering in a very simple way is aligning the whole organization and people towards a certain strategy, in this case, and reduction of emission, of putting climate targets. The point that it requires a double view, because we need to speak about climate targets and climate targets that support the financial results of the company. So it's both a top-down and a bottom-up exercise. Top-down sets the ambition, and this is very important, especially when you start on this. We did that in December 19 with putting our objective of being net zero in 2050 with a number of interim targets. Then along the way, we have been able to increase our climate targets because we started with a bottom-up exercises in which the climate targets are the results of the decarbonization projects which are profitable that we have in our portfolio. So combining ambition at the very early stages with then putting all the organization to look for profitable projects in the low carbon space, then you get a bottom-up exercises in which hopefully you can even increase your climate targets. That's the way we did it, and that's the way we. So there was a mention before by one of the panelists about the link between, let's say, your projects and your capital allocation and investments and the climate targets. Definitely, one is the results of the other. When you have a mature organization, is the capital allocation which sets which are the climate targets you can reach. Now,
Mr. Cabra, the bad news is that there's quite a stack of questions all aimed at you. So I hope you're ready. But before we go and move on, Mike mentioned the US backlash, ESG backlash, and given that Repsol is quite high on the push towards renewables, have you seen any US shareholders saying, "Oh, that's not for us, thank you very much," and disinvesting or selling their stake in Repsol, or have they been relatively sanguine, concentrating more on the returns that you're getting despite this move?
Well, and again, this is something in which we need to be quite, I would say, cold. On one side, you may see certain type of political uncertainties, and which are the political readings about what may happen in the future because there is an administration that changes, etc. So at the end of the day, you need to figure out which is going to be the specific impact in the drivers for your returns, for instance, in regulation. So in the United States, there is the IRA, the Inflation Reduction Act, that it might be touched, it might be modified. We have made our own assessment of which are the elements that most likely could be, and I put all this in conditional, could be modified. And we see that basically, if there are some changes in the IRA in the way we believe it can be softened in some way, the impact on our internal rate of returns are quite moderate. So to answer very specifically, if you are speaking about our investments in the US on renewables, because it's our number 2 country after Spain for investment in renewables, our plans are still intact. There is some political readings also about the fact that most of the beneficiary states of the IRA are Republicans, and that makes an influence, or that may have an influence on the decisions that will be taken by the new president. But well, this is very political reading. So for us, no reason to, let's say, to give a step back on our plans, both for renewable electricity generation, but also very important, and this is for the European geography and more specifically for Iberia, of our molecular renewable molecules projects, which is the conversion of our refineries progressively for more biofuels, advanced synthetic fuels, etc.
Great. Now, what I'm going to do is give you a moment to rest, Mr. Cabra. I'd like to ask Mike, when you talk to investors about engaging with corporates, what are the most frequent misunderstandings they have about a corporate setting a climate strategy?
Sure. I think I'll sort of start off with where I sort of left off in the previous comment about actually what is a climate strategy. And I think if you're a demand company, a demand side company, and you make widgets, ultimately the energy transition and responding to climate change is about decarbonizing your production of those widgets. If you're a supply side energy company, ultimately you need to reduce the climate impact of your business by reducing emissions associated with your business activities, but you also need to reduce your exposure to climate-related risk. And those two things are related, but really quite separate things. So for an oil and gas company, as the world continues to electrify and move to renewable-based electricity and energy systems, ultimately it's responding to that challenge by planning for your oil and gas and coal, if you're a coal producer, production to decline over time. Additionally, you want to reduce the emissions associated with your business. But I think there's a lot of conflation, honestly, with investors and from a misunderstanding perspective between those two things. So you want to assess corporates' exposure to climate-related financial risk and the pace at which they are moving away from sectors that are exposed to that. But you also want to separately assess corporates reducing emissions, and the two are not quite the same. You can use similar metrics, so looking at CapEx plans or production plans, and in this case, emissions targets, to give an indication of both, but really separating those two. And I think that actually a misunderstanding is that some frameworks and some metrics, which are inappropriate to assess one type of transition, so reducing risk exposure, sometimes investors are using the other type or metrics which are appropriate to assess the other type of transition. I think linked to that is that corporate climate-related risks, and for oil and gas producers, that is the risk to demand substitution of their core product, i.e. demand falls as EVs roll out and battery technology grows. That climate-related risk is somehow dismissed as an ESG factor, and it's effectively just an environmental problem, and we shouldn't worry about that because that's somebody else's problem. That's a sustainability problem. No, it's a fundamental business risk, and I think we've, in the time I've been at Carbon Tracker, we've seen a greater acceptance and recognition of that. But I think there's an awful long way to go for that understanding to be fully embedded within the financial markets. Climate-related risk is a fundamental business risk.
Okay, so and bringing Repsol back in, Mr. Cabra, again, same question to you. When you engage with investors, what are the most frequent misunderstandings they have about how either difficult or about the strategy behind setting climate goals? What are the biggest misunderstandings?
Okay, I'll go specific to your question in two seconds. But first, my first reflection is we do not have a generic investor. We have investors with a significant range of views about the energy transition. Some of them, they may think sometimes they are a little bit concerned which are the risks of going too fast in the energy transition. Others maybe are on the other stream, thinking that the energy transition is going to be faster and we have a higher risk than we think. Having said that, specifically to let's say, if we think on accelerating the energy transition, which is the main misunderstanding with certain investors and also prescriptors and rankings and so on, is the fundamental question and then the fundamental answer on whether you are aligned, a company like us are aligned with net zero objective, 1.5 degrees C, Paris Agreement, etc. And I believe there are significant misunderstandings in that answering that question. On one side, we need to face a reality. There is no standard, no procedure, no accepted methodology in order to assess that. But on the other, to be very frank, I see sometimes relatively loose analysis when saying, okay, this company is aligned or not aligned. Just an example. And I believe we had the opportunity to share with a number of investors and even with you in October, how we think we can address this fundamental question. Because now there are some school of thought, I would say, that is saying, because the world needs to reduce emission by 45% in 2030, every company should do the same. So if you do not get a reduction of 45%, you are out of the picture, you are not aligned. The answer to that is, look, if we see at the net zero emission scenario of the International Energy Agency that specifically, yes, they call for 45% reduction in 2030, but the reduction of oil and gas in the scenario, net zero scenario of the Energy Agency is 12% reduction for oil, 9.5% reduction for gas in 2030. And this is absolutely compatible because this is what the world needs and compatible with 45% reduction of emissions because you need to reduce by 75% the coal used for generating electricity, which is more achievable by 2030, and you need to increase your production of renewable energy in a very aggressive way. So the point is that if we demonstrate that our production of oil and gas will go into that direction, that the reduction of emissions coming for our portfolio goes into that direction, 45% is not a simple magic number that everyone needs to comply with. This is a little bit more complicated, requires analysis, and requires engagement with investors and engagement with prescriptors, and this is what we are willing to do. And well, we will provide further details on our analysis on this specific topic in our integrated management report that we for 2024 that will be published in February.
Okay, no, that's great. Thank you. And Mike, just before we move on to the next question, because we've got quite a few, any quick points?
So I mean, on the first point, I would agree. Actually, I would definitely agree that you can't just apply a blanket. All companies must reduce at the same rate, and this is what I talked to you before. We think there are ranking and assessment methodologies out there that are fundamentally flawed. If they just say, well, the sector needs to do this, and therefore individual companies must do that. Our view is that we need to be much more differentiated around that and take into account companies' existing portfolio and the rate of decline of production from those existing assets to assess companies' Paris alignment viewed through that climate impact reduction lens, but viewed through that energy transition risk exposure lens, again, similarly thinking about production declines. And ultimately, if companies continue to develop new assets to kind of keep production flat or in some cases grow it, those are the ones that I think should be are most at risk of becoming financially stranded or at risk of kind of being contrary to climate goals. So my message to investors there is you need to take a more differentiated approach and use some of the use the analyses out there that do look at the leaders and laggards and both from a climate and risk perspective in assessing that. And obviously our tools can help do that as well.
Great. So, okay, Mike, thanks very much. And I'd like to move on to a question from Miguel. Repsol's current strategic plan allocates over 35% of investments to low carbon businesses. You're really screaming ahead of a lot of the crowd here. Are there areas that you feel you're lagging behind in, that you want to catch up? What can investors see in terms of investment priorities, going out to the future?
Mm-hmm. Yeah, you're right. We are already in the process of executing our latest update of our strategic plan for the years 24 to 27. What things are going as we expected or even better? On one side is renewable electricity production. We believe we are fulfilling all of our objectives of growth, starting from zero production back in 2018. By the end of next year, we will be installed capacity of 6 gigawatts of solar, wind, and some hydro. So this is going especially with a lot of effort, but specifically as planned. On the other side, I would say that investment in renewable liquid fuels are going quite well. There are not so many in our portfolio, but we have a couple of projects that are exceeding our thresholds of internal rate of return when being executed. I'm speaking about an advanced biofuels plant in Cartagena refinery and a second plant of the same nature in Puerto Llano. Number one is already in operation. The one in Puerto Llano is being engineered and constructed and is going to be on stream by the end of next year or early 2026. We are quite okay also when looking at our, let's say, retail. We have been able to build a significant size of customer base for selling electricity for home. That is a new business for us. Now we have in Spain more than 2.5 million people, and we plan to be at 4 million in 2027. Something that can be a little bit lower than expected, I would mention hydrogen. Hydrogen, it's okay. We need hydrogen. We use a lot of hydrogen in our refineries. We need to progressively substitute the hydrogen from natural gas because it emits CO2 by green hydrogen, electrolyzers and so. And well, for the time being, we have 3 projects in the pipeline, still pending final investment decision. We hope to take this decision by next year, but we still need some clarity on the regulation, European regulation, just to check that the cost of hydrogen can be compensated by the price signal which is in the market. There is still some uncertainty in the progressive regulation that is in place. So we need to look at that a little bit more carefully, but on the positive side, we are very happy that the European institutions are offering significant CapEx support. And we have in the 3 big electrolyzers that we have plans to approve next year, the 3 of them, they have a significant CapEx support from European institutions. So, but we are a little bit delayed on that. So definitely hydrogen is, I believe there is some sort of hype on hydrogen and how fast hydrogen can be deployed. But definitely we have no reason to delay that because the big thing is that we are consumers of hydrogen. We have the demand of hydrogen already in our refineries. Other applications need building a brand new demand, and this is going to be more difficult.
So we're getting pretty close, but I want to squeeze this one in, Mr. Cabra. And it's a question for John. The Absolute Impact 2024 report shows Repsol relatively high ranking of emissions goals as their third. Can you identify any cost to Repsol in achieving such a high ranking, or should your shareholders view this as a good investment?
Definitely, it needs to be the second. the cost at the end of the day needs to be compensated by the benefits. So again, we always transmit to our people in the organization, we are going relatively fast in the energy transition because we see opportunities in the energy transition. And project by project that we are sanctioning, and our shareholders wouldn't allow us to do differently, and our board, they have a return. You may have seen, if you look at our strategic plan that has been released in February 24, that we said very explicitly which are the internal rate of returns that we expect from each of our businesses. Of course, more risk, more reward. And for instance, we expect our E&P investment. We need to maintain investment in E&P to have a sound production of hydrocarbons. We expect internal rate of return of more than 15%. If we go to the other side, for our renewable electricity generation projects that you cannot expect, because these are relatively low risk projects, you cannot expect internal rate of return higher than 7-8%, but we have an explicit strategy to incorporate in financial partners once we have the risk, the projects, so we can leverage our equity returns to be double digit. We have got very good experience. We have already incorporated partners in Spain for more than 800 megawatts. And for all this capacity, our equity return is ranging between 13 and 16%. It was at the beginning 8 to 9%, but then leveraging on the incorporation of, let's say, infrastructure funds and other type of lower risk, lower return partners, we are able to leverage on that. So definitely, we see an investment, significant investment in the energy transition, but this is an investment with returns.
So, I mean, I guess the key takeaway from if you like, talking with you, Mr. Cabra, is that the idea that renewable energy is low returns is not quite right. Thank you very much indeed, Mr. Cabra and Repsol, for spending the time. It's the end of the year. We will return to the webinar stage as early as the 15th of January, where we will present Turning Tides, which discusses the uncomfortable truths behind the financial economics of the LNG market, using British Columbia as Canada as a case study. Watch out for the save the date email this week, and again on the 29th of January, where we present our latest report, Petrochemical Imbalance, which uncovers the problematic economical and financial foundations of the oil and gas industry's much promoted pivot to petchems. Both reports are available on the website now if you'd like to download them. So it only leaves me to thank my presenters and panelists, Olivia, Rich, Mr. Cabra, and Mr. Lorenzo, and of course Mike Coffin, and to the off-camera team, although they are actually on camera there, you can all see them. Many of the names I'm about to read out will be very familiar to our investor audiences. Mr. Antonio Lopez, head of the energy transition, Mr. Pablo Banatin, director of investor relations, and Ms. Leticia Padura, again in the investor relations team and ESG senior manager of Repsol, and thank you for contributing and to this great webinar. To the off-camera team at Carbon Tracker, slightly smaller, Piotr Kurzin, he's part of our events and media team. And lastly, thank you to you, the audience, for your time. It only remains for me to wish you all a very happy holiday period.